The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe with Karen Cho, myself, Steve Sedgwick, and these are your headlines. President Trump says Venezuela will give up to 50 million barrels of oil to the US and that he will control the proceeds.
The White House refuses to rule out military action to take Greenland as European leaders issue a statement pushing back on President Trump's comments about acquiring the territory. And Nvidia fires up production of its H200 chips with its sights set on China. As CEO Jensen Huang tells a Las Vegas audience its export licensing agreement with the White House is almost done.
Morning. Thank God for your third headline, because otherwise I was thinking someone's pulling my leg on the first two headlines. It's what world, good morning to you by the way, what world do we live in where America is potentially threatening or refusing to rule out military action on Denmark, an ally, on an area where they can actually put as many troops as they want like there anyway. They could have as many deals to extract resources they want anyway, or almost certainly, but they want to have military action. But that is not even the most gobsmacking of these headlines, which is an extraordinary state of affairs. Okay. The fact that all pretense that this extraction of Maduro was about narco-terrorism or bringing a drugs kingpin to justice is just completely out the window. All pretense that there is a process which the US administration wants to bring democracy to Venezuela is out the window. To just say Venezuela has hundreds of billions of dollars of liabilities on a global basis, some of them to US oil companies, to US entities. But to say we're just going to have now this 50 million barrels of oil, we're going to take them, we're going to take 3 billion, we're just going to take them and I'll work out the process. It'll be fine for the Venezuelan people. It's just gobsmacked. This is just a shakedown, isn't it? I mean, what world do we live in where the US, the paragon of the liberal democratic order for the last 80 years, is just now saying, yeah, we'll have that oil, and for what justification? It's a big cloud of geopolitics messed up with a whole heap of commercial interests, isn't it? And we've seen that over the tenure for the last number of months, really, and that's been around the tariff situation expressed and how the US is putting its interests first, whether it rocks the boat with allies or foes, it doesn't matter, around commercial interests. Now we're seeing it escalated to foreign policy and geopolitics here. I think what's interesting in the backdrop of all this, markets are still rallying. We had a fresh record on the S&P 500 yesterday, following up the record we saw on the Dow a day earlier. So markets are seemingly looking through this, which is extraordinary to your point. It's such a big event in terms of world affairs and how we see leadership from the United States and how that has implications for other countries with consequences. Yet the positioning for investors is to buy metals, to buy into a rally and to pump up other areas of the market. And I think that's historically fair enough. I think avoiding geopolitics and, sorry, let me put it another way. Looking at terrible geopolitical events and then trying to extrapolate a market meaning from that is a fool's game. 9 out of 10, 99 times out of 100, just get on with the real economic factors in the markets and business whatever, because geopolitical events don't affect. But I think there is no risk being associated with policy actions, a policy mistake from Trump, a policy mistake, whether it be Greenland, whether it be something in Mexico, whether it be something in Colombia potentially, whether it be something in Venezuela, because there's some great commentary out there, and you've been reading a lot of commentary as well, I know. But the risk of Trump making an international relations geopolitical policy mistake that has great ramifications for our viewers and for investors is getting ratcheted up, and no one's actually even thinking about that because he's floundering at home. He's not getting the numbers he wants in the polls. He could lose control of the House, at least in the midterms, and he's trying to look for quick wins, and he thinks he can find them by adventurism on the international stage. And that is terrifying. I think one of the interpretations in the commentary that you mentioned that I saw was that there could be a win for the world economy in terms of low oil prices from here, which, you know, you think about the tailwinds going into 2026.
we're looking at some of the fiscal stimulus. One of the guests was talking about it yesterday from the United States, some of the fiscal stimulus in Europe, but a lower oil price sets the scene for the consumer side as well, because it does take down the cost that consumers are paying at the pump, businesses as well. So that tailwind for the economy, I think that was really interesting, that was one of the potential upsides that the market was looking at.
Yeah, and I hear you, but if you have too low oil prices, the cure for low oil prices is low oil prices. And the problem is, if you have these very low prices, the incentive for the producers just isn't there, whether it's Exxon, whether it's Saudi, or whether it's Venezuelan, Orinoco Basin investment, it's just not there. So there is an equilibrium price, and this is something I learned from my time, debating between the IEA on one side and OPEC on the other. And quite frankly, we are at such historically low levels on oil. I mean, yeah, I appreciate there is an inflationary problem in parts of the world, and certain products are expensive, but oil isn't one of them. Oil is actually pretty cheap if you look at the historical charts and look at it on inflation adjusted. So I hear what you're saying, but the danger is if we keep getting these downward impetuses. By the way, the hedge funds are short incredible amounts of oil at the moment. They think this trade's going lower. If we keep getting that, it's going to be a lack of investment, which is going to create a medium-term problem.
Well, to me, there are other issues, and the story that you're seeing around the geopolitics in Venezuela is another just rendition of this scrabble for resources that people want to ensure that they have the security in supply chains. You saw it in the back end of last year around the metals prices. You've seen it in recent years around rare earths. Some of these issues are going to get magnified as we see a race towards AI. So what you've seen in various parts of the world, I think that only gets worse in coming years, and that has implications for investors in the build-out of AI.
So our top story, which we've been discussing, is US President Donald Trump says Venezuela will turn over between 30 and 50 million barrels of what he describes as high-quality sanctioned oil to the US, which he will then sell at market price. Trump says he has asked the Energy Secretary Chris Wright to enact the plan immediately. Well, speaking to CNBC, the former Federal Reserve Governor Randall Kroesner said that whilst American oil majors are keen to access Venezuela's crude reserves, it's still early days.
The refiners are very eager to have access to this. Obviously, the embargoes reduced the amount of Venezuelan crude that was coming out into the market, and so this takes a step towards restoring that. Obviously, we're going to have to see what happens over time. This is sort of like one first step. We have to see what the regime within Venezuela is going to do, and how the U.S. is going to interact with that. How these things are going to develop. I mean, it's very early on to be able to say anything definitive, but it's clear that it's about oil, and that it's no surprise that the president has taken a quick step to try to move some of that heavy crude towards the U.S.
Let's take a look at where the price of oil is trading. Brent just sub $60. Been flitting around that level for quite a while. WTI 56.17. Our US colleagues will be speaking to the US Energy Secretary Chris Wright later today. That exclusive interview coming up at 1900 London time.
Well, switching to the politics closer to home, the Trump administration is considering a range of options, including the use of the US military in order to acquire Greenland. White House Press Secretary Caroline Leavitt told CNBC yesterday. However, Secretary of State Marco Rubio reportedly told lawmakers on Monday that the administration's plan is to buy the territory rather than invade it. Trump's renewed rhetoric around Greenland has received condemnation from European leaders who stress the island belongs to its people. In a joint statement, the leaders of 7 European countries emphasized that Denmark, including Greenland, is part of NATO and that Arctic security must be achieved collectively. Meanwhile, Greenland's foreign minister said the government has requested a meeting with Marco Rubio. Speaking to CNBC yesterday, Europe's Commissioner for Defence echoed warnings by Denmark's Prime Minister about the end of transatlantic alliance if the US takes action on Greenland.
Well, it's a totally different case, and definitely such statements are totally unacceptable. We're standing together with Denmark, and I agree with Danish Prime Minister Frederiksen when she said that if things will develop up to such a case that Americans will take some actions against Greenland, it will be the end of transatlantic partnership. So that is very serious, and I hope that Americans will take also evaluate their actions in a serious way. And from that point of view, really, our position is very clear.
A look at those US markets in session yesterday. You could see the green splashing up across the boards for the Dow, the S&P and the Nasdaq. The Dow again added a fresh all-time intraday high, record close again. The S&P 500 joining it with that record finish as well. But of course, third positive session is what we witnessed. It was interesting to see the mix of stocks too that were driving the major boards forward. It was Amgen for the Dow, for the S&P 500, it was Amazon. And if you look at the Nasdaq, again, a different company, it was Micron. So a little bit of breadth in terms of those three top movers across for the major boards. In terms of Asia today, picking up on some of that action stateside, we are seeing a little bit of red fade for the Japanese stock market. It is down 1%, so some of those gains not translating. Hong Kong stocks also giving back territory. The Shanghai market perched slightly firmer, and you can see a decent old day for the South Korean market that seems to have picked up where it left off in 2025. A monster rally, best market to trade in 2025. And again, it seems to have momentum coming into 26. To the European futures, we've had some momentum too on this side of the world. We've seen gains on the Stoxx Europe 600. We saw a fresh all-time high in session yesterday. The FTSE 100, again, fresh all-time highs, 10K, the number we ticked past. And we saw a little bit of appetite too on the Xetra DAX, slim range, but fifth straight session to the upside. Today we are chasing a weaker start for the UK market. Not much on the French market, again, that's been more muted, but gains expected to translate for German and Italian names there on the charts. Now, US futures, a quick look at the day later on stateside. We are seeing a bit of a mixed bag. It looks like slim range this side, maybe even lacking direction after those records.
Hetal Mehta is Chief Economist at St James's Place. Hetal, lovely to see you. Thank you for being so patient before we got to you. Look, I 100% believe that in my nearly 40-year career in looking at markets or being in markets, that it is right to ignore geopolitics a lot of the time. Is this one of the cases when the market is ignoring geopolitics but shouldn't be?
I think our view is that, geopolitics is always going to be a latent risk. We get flare-ups very frequently. And, you really have to think about it from a long-term investment perspective. And actually, there are many flare-ups which in the moment feel like they are meaningful, and investors often make knee-jerk reactions, maybe pull out their money. And actually, it's much better to take a step back and understand whether what's going on changes your investment objectives, whether there's actually anything you can know or predict, and rarely experts can know or predict what's going to happen. We can all speculate, but forecasts and predictions in this area don't have a very good track record. So I think it's probably a better thing that we haven't seen too much reaction. I think it really is still pretty early days in terms of knowing how much infrastructure investment will take place, what the long-term impact on oil prices is.
Okay. In terms of where to find defensive assets to be long of, then, let's put it that way as well. Where do you find value at the moment?
So in terms of our kind of overall asset allocation views, we actually have a preference for Europe, also the UK, Japanese equities as well, and emerging markets. So effectively kind of non-US equities generally. So US being pretty overpriced, and the other regions kind of being a good offset with a higher chance of creating positive returns.
Hetal, we've seen some element of a bounce in markets for January, which is prompting the question, what could go wrong for 2026? Is it all blue sky from here? I can see you've got a probability of a US recession that you've lowered from 35% to 25%. We had an argument overnight from Stephen Myron over at the Fed talking about the interest rate scenario holding back the US economy. What do you think? What does the outlook look like for the US? Do you think that there is an argument that lower interest rates would be more supportive from here?
So for us, I think a lot of the headwinds that the US economy were facing last year have faded. So obvious one on tariffs and the trade wars. But we've also seen signs of resilience from the US consumer. It's long been the engine of growth there. And despite the higher inflation, despite higher interest rates, the consumer has actually kept on going. And that's also with the labour market slowing, and also with savings being run down. So there's a lot of resilience, I think, we can see in the US. And as those headwinds fade, we think there's enough monetary and fiscal policy support to sustain the economy this year. The reason why I haven't taken the probability all the way down to say 10 or 15%, which is your kind of really clear blue sky kind of figure, is because we do still see some fragility there. The US consumer highly concentrated in terms of spending, in terms of higher income households. The lower 50% of income households actually only own about 2.5% of the wealth in the US economy. So it's not an even recovery, and it's not an even type of growth. Would lower interest rates help? Yes, potentially they would. But I think we also have to bear in mind that whilst there's been progress on inflation, we're not quite at the point where economies need to have kind of stimulative interest rates. We don't need to go below neutral. And the risk is then you start having inflation risk pick up again.
Right.
And then you'd actually see a more aggressive rate tightening cycle.
Hetal, the question then is, would lower oil prices help? Because as you point out, some fragility in the consumer market stateside, the K-shaped economy as it's been called. If we're talking about lower oil prices now because of the geopolitics around Venezuela, would that help provide resilience stateside?
I think it would help somewhat, but again, lower oil prices and lower inflation tends to favour those on lower incomes. And as we've just said, they're the ones who actually spend less in the economy as an overall share. So yes, it's a help, but it's not maybe quite the same boost as it may be in other economies that have a more even spread when it comes to consumer spending.
Hetal, once again, the markets seem quite ebullient about sectors they haven't been previously, including looking at areas such as United Kingdom. Close to home, what do you think? Because the political situation looks dire for the Prime Minister at the moment. The economy is really just motoring along at such a low level of growth, but the FTSE's gone bazooka, something like that anyway, to the upside. What do you think?
Well, one of the key things to bear in mind is that what happens to FTSE is not necessarily a reflection of what's going on in the economy in the UK. There's obviously a big disconnect with foreign earnings. I mean, the UK economy is, as you say, kind of trundling along, muddling through. The fiscal situation is not going to help in terms of we still have latent fiscal tightening going on. For the Bank of England, again, they're still, I think, caught between a rock and a hard place. The inflation numbers have been surprising to the downside in the last few prints. But again, are we at a point where they need to stimulate the economy, risk inflation, that unwinding that inflation progress? I don't think so. So I think it's very kind of steady. Last year we said that we'd see a quarterly pace of cuts, and we saw that play out. I think this year it's a little bit harder to make that call because it is very finely balanced.
Hetal, thank you so much for joining us this morning. We appreciate you weighing in. Hetal Mehta with us, Chief Economist at St James's Place. Coming up on the show, Jensen Huang reveals to CNBC the level of Chinese demand he's seen for the firm's H200 AI chip. Plus, progress on peace. A coalition of the winning deal could see foreign boots on the ground in Ukraine. We'll have the details on how the US is involved. And BlackRock's Helen Jewell will be in the studio later this morning, outlining why international equities are well positioned in 2026.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Nvidia CEO Jensen Huang says the company is seeing very high customer demand in China for its H200 AI chips amid recent signals from the US government that it would approve them for export. Huang said the chipmaker is in the process of figuring out the final details on export licenses with the US. Speaking to CNBC at the 2026 CES event in Las Vegas, Huang said Nvidia is omnipresent in AI.
We're the only AI company in the world working with every AI company in the world. We run every model from OpenAI to This year, we announced Anthropic, and I'm very excited about that. Of course, we have the benefit of working with Elon and XAI. We've always been working with Google on Gemini. And so Nvidia is the only company in the world that runs across every domain of science, every AI company, every AI model. And the only way to do that is to do it openly.
AMD CEO Lisa Su highlighted the rise in AI users and consequent demand for compute.
When we look at, just the demand environment that we've seen just over the last couple of years, just today, we have like 100 zettaflops of compute, which sounds like a lot. It's 100 times increase over the last, 4 or 5 years that we're projecting forward, and we're seeing a demand environment where you're going to have, you're going to go from 1 billion active users in AI today to over 5 billion active users over the next 5 years, and so you need a lot more compute.
Put the two comments together from Su and from Huang, and what you've got is a whole conversation around compute, that everybody's seeking more, the demand is there from the Chinese too, which Nvidia is seeking to fill, and they've often spoken about this being a $50 billion market. It's not in the Nvidia forecast, so if that were to come through, and let's face it, they've already put their chips on the table, they're making them, they're in the supply chain, they've started producing them, hoping they get the final tick of approval to export them to China. What sort of advantage does that give the Chinese? Because they are seen as a huge threat. Don't forget they've got different means of going about building out AI, not coming up with the top level technology, but clustering together all of the chips they can put together. Maybe a heavy drain on electricity, but that's not a problem. They've got a ton of electricity at cheap prices, so they can still power some of this technology and make it competitive against what you're seeing in the United States. So could we see a firmer player in the Chinese market if these H200 chips are exported? The other point here is that this is about compute. The other reality that Jensen Huang was making in that conversation is that they are omnipresent. They're not just present in compute, they're now moving into the platform space, the application phase. So it means a much stronger play if it's got geographical spread, but also vertical spread in various parts of the AI stack.
Absolutely. I want to look at it from what's in it for our viewers' point of view as well. And I do my compare and contrast all the time and just look at bog standard valuations. I try to be more Buffett-esque about this in a very lowly way. Right. And when I look at some of the valuations, both in the private and the public market, I struggle. When I look at the valuation of Nvidia, I kind of get it. I look at Tesla at 200 times forward. I find that quite a hard purchase, even if you think that he's going to deliver on everything. When I look at OpenAI IPO valuation of $1 trillion early stage, I find that very difficult. When I look at Nvidia at $4.5 trillion market cap, I find that easy to understand because just look at the numbers. I'll do a quick Nvidia versus OpenAI comparison. Nvidia made about $32 billion last year, vast amounts of money, whereas OpenAI loses around about 10, 11 billion a quarter. So it's got a massive cash burn as well. So that's the first thing. One's making a lot of money, one's losing a lot of money. The other one is the sales figures as well. Now, the sales figures for OpenAI are expected to be between $30 and $40 billion this year. The upper echelon is about $41 billion. So let's say $35 billion. Mm-hmm. Now, if you've got $1 trillion valuation on the $35 billion sales, just back of the envelope, thinking off the top of your head, that's about 30 times sales. Nvidia trades at about 24 times sales. So I'm struggling everywhere. One makes vast amounts of money. The other one loses vast amounts of money. The other one has enormous cash burn. One of them has huge cash generation. One is valued at, and this is the other point, Nvidia on the market is valued at about 24, 25 times forward. The valuations for OpenAI are off the Richter scale. So I don't understand why Nvidia is being discounted compared with some of these other players who have never made a bean and haven't got the business model yet.
If I can take that a bit further, if OpenAI wins, then Nvidia wins. If OpenAI loses, Nvidia still wins because it's partnered with everybody else in the large language model sector. So it's got its distribution there. It's partnered with so many companies. So Nvidia has that breadth and that resilience. One of the other points that has just come up time and time again is that how nimble some of these companies are at spreading their business model now. They don't just stay in their lane. If they're experimenting with AI, they discover they have some capability, and then they go into that segment too of the market. So they're not staying like the old days of Google doing what it did in search, and not really needing to expand beyond that because it's such a dominant player, had so many dollars coming in. But now if Google, for instance, goes into an area and discovers it has some capability and looks around, well, actually the biggest player in the room still. So I think you're seeing from the Mag 7 stocks that they've learned a lot from the last 10 years. They have deep pockets and they're experimenting around AI. They're willing to change the business model. So the point I've been making all week is that can you really write off any of the Mag 7 stocks because they do have the edge and they're willing to encroach upon territory that they wouldn't have even strayed into previously.
So if you can't write off these kind, and I agree with you, Alphabet had a brilliant tail end to a redux story at the tail end of 2025 on their AI offering, and people because we're very worried about the traditional search, and there's a comeback. So they can't all make the kind of money and margins they expect. There's going to be commoditized products at some stage, whether it's 2026, 2027. So I don't see how some of these valuations for Anthropic, for OpenAI, for SpaceX, slightly different company, for XAI, we'll come to that in a few moments' time, I don't see how they make sense, given the fact that there's a degree of caution on people like Nvidia, but no degree of caution on the private sector valuations.
Yeah, well, the difference is, I think, if you've got a smaller, slimmer business model, are you just going to stay with that one business model and then competitors crop up and suddenly you're not looking at the same pool you were looking at? I mean, think about Mistral AI, which was a startup in France. It started out as a large language model. It is now building sovereign cloud because it worked out it had capabilities in infrastructure as well as it was beginning its AI journey. So I think these companies are learning what they can be and what their overall business model should look like. And that means that there is more of a competitive threat for some companies and more resilience for other companies that are working hard to create that breadth. So this story for me means a Mag 7 dominant story still for 26.
Talking of the big companies, XAI said it had raised $20 billion in a funding round, beating a prior target of $15 billion. Investors, the aforementioned Nvidia and Cisco amongst them, who work with the company as strategic partners and vendors, of course, the so-called doom loop ecosystem, call it what you like. The UK's Technology Secretary Liz Kendall has called on Elon Musk's X to deal urgently with its Grok AI bot, which has been used to create deepfake, sexualized images of women and, according to Reuters analysis, children. Kendall, whose intervention is the latest in a series from governments and regulators around the world, called the phenomenon unacceptable in decent society. Earlier this month, Musk reposted a generated image of himself in a bikini with a laughing emoji. In a statement, X said it takes action against illegal content on the platform. Okay, you can find the latest developments on this story on CNBC's website.
We are counting down to the start of the European trading session. A look at how futures is shaping up. We saw a mixed board as we checked on it first up at the start of the show. You can see the FTSE are seen weaker today, but appetite coming back into the market for German stocks. French market that was flat also seen higher now.